One of the leading companies in data streaming is called Confluent, and it's one of my favorite stocks to follow and a company that I think has an incredibly bright future. But the reality is its growth is slowing down. There was an under the radar announcement the company made in the middle of February that I think could supercharge its growth and makes it one of my favorite growth stocks to buy right now. I'm Jason Hall. This is Investing Unscripted. We're going to talk about that announcement, what's going on with Confluent's growth, and why I think now is a great time to be buying. This video is sponsored by The Motley Fool. If you're looking for even more great stock ideas, you should go to our special link. You see it on the screen. It's fool.com/unscripted. The Motley Fool is going to give you its 10 best stocks to buy right now if you go to that link. Check it out. Before we get into the announcement that Confluent made, I want to take a second and talk about what Confluent is. Here's a couple of slides from the company's presentation. Basically, what it demonstrates is that companies with their stored data, you have all sorts of things that make it really hard to leverage that data in the most effective ways. You have different segments of a company that might use different software, different database applications, siloed from data in other places. You may have the sales data, marketing information, customer information, inventory, pricing, suppliers, all of the data from all these different sources in a lot of cases is not connected. And that makes it really hard to make the most out of that data. So Confluent, its data streaming platform, which is built on Apache Kafka, which is open source, it was actually created by Confluent's founders. The idea is that it can take data from basically everywhere, get the data where it needs to go, apply analytics, allow businesses to be able to react to that data in real time, and proactively build their businesses to compete in a real world economy. Now, Confluent's business, again, is built on top of Apache Kafka. This is an open source product. It is by far the leading open source product for data streaming. And in a way, it's a little bit like a freemium model. We talk about other software companies that have this freemium model where there's a free version of the software that businesses can use, maybe limited features, maybe for small numbers of with limited features, or maybe limited to the number of people that can use it. And it gives them a taste of it. And the idea is that companies will try these applications out. They'll find out that it's really powerful, and then they need to pay up to get all of the features they want, or they need to expand it in their enterprise, or maybe they need to integrate it more, or maybe transition from another similar competitive product to the product that is being offered. And with Confluent, it's the same thing with that open source Apache Kafka. Plus the fact that it's open source, you have thousands of developers, hundreds of large businesses, enterprise scale businesses that are using Apache Kafka and actually improving it in the real world. At Confluent's Investor Day back in June of 2023, they released some interesting data about Kafka. We're approaching 1 million active monthly unique users of Kafka. And basically every large company out there at some level is using Kafka. More than 3/4 of the Fortune 500, all of the largest enterprises in so many different industries are using Kafka. So many of these companies and businesses that are using Kafka get to a point where it's hard for them to dedicate the resources, the specialized resources and developers to manage Kafka, write code to customize it, make it work perfect in their enterprise setting, and leverage it in the best way. And that is where Confluent comes in. Whether it's for businesses that are using Apache Kafka on premises that have data in the cloud, or maybe a hybrid version of both, Confluent has built a wonderful suite of products and services to leverage all of those different ways to use data streaming. Quora is its custom built Kafka engine for the cloud. The idea is that for companies that want to fully leverage data streaming, but don't want to dedicate internal resources to do it, and are looking for more off-the-shelf products, looking for a trusted partner to help them with their data streaming, this is where Confluent comes in. The reality is, it's not super easy for businesses to transition away from legacy data products, or even from Apache Kafka, or some of the competing products that are out there to fully make that transition. This is the announcement the company made back in February that may not be getting enough appreciation for what it could do to help really supercharge the company's growth going forward. And as you see in the title there, Confluent Migration Accelerator. The reality is this is going to help companies start to decouple from legacy products. And also, this is the most important part, make the switch to a complete data streaming platform. The biggest challenge, simply put, has been managing Kafka as you want to do more and more, having to build dedicated teams internally, hire developers. These developers are very well paid, and you're competing for a lot of that talent now. Confluent is in a wonderful position to help companies be able to leverage that and take that problem off of their desk and to be the trusted partner. There's some great partners that are part of Confluent Migration Accelerator. Well, there's three. There's three that are partners, but also competitors. I think that's important. We have AWS, Amazon Web Services, Google Cloud, and Microsoft Azure. This is where the enterprise data is living in the cloud on one of those three large cloud providers. Now, they also have their own streaming applications, but it's clear that they see the importance of making sure they're partnering with Confluent because they need to be lined up to keep those customers as cloud customers, whether they're using one of their proprietary streaming products or they're just using the cloud. Now, you also see this is important. Companies like EPAM Systems, which is one of the most important tech consultancy companies in the world. So you have some really strong partnerships with companies out there that are helping integrate these solutions, that are making the professional recommendations to their clients. So a lot of really good things happening. Now, why is this important right now? As much as this is a growth opportunity, we're starting to see some deceleration of growth for Confluent. So we'll start here. Back in 2022, the company identified $60 billion in total addressable market. That $60 billion addressable market is expected to be a $100 billion addressable market just next year. It is a very fast growing, significantly large market. The reason that announcement I think is so important and that giving potential customers the tools to be able to make the transition over to Confluent is so important is because the growth rate is good, but it is starting to slow down. We look at subscription revenue. This is the vast majority of the company's revenue. If we look at the fourth quarter of 2023, revenue was up 31%. That is down from 44% in the fourth quarter of the year before. And I believe it was in the 70s if we go back to the fourth quarter of 2021. So revenue growth is certainly slowing down. The company's guidance for the first quarter, it's looking for two things that are going to be really surprising. Around $200 million in subscription revenue. So the first thing that jumps off the table at me is that's about 24% growth from where its revenue was, its subscription revenue at the first quarter of last year, $161 million roughly. Also, this is going to be the first quarter, again, if that's where the number comes in, if it's within the range of guidance, it's actually lower revenue quarter over quarter. I will say, if you look back through here, it's typical that revenue from the fourth quarter to the first quarter usually is the growth rates have been slower. Those numbers have been closer together just because the fourth quarter is the end of the year for a lot of businesses. They're doing a lot more analytics. They're processing and streaming a lot more data, especially you start looking at retail customers and other businesses that are affected by the busy holiday season. That's part of the reason that's the case. But again, it's going to be the first time that the company's subscription revenues will actually potentially fall from the prior quarter. Now, they do have a history of exceeding guidance in most quarters, so we might not see that happen. But the point is still the point, and that is growth is starting to slow. By building some really key tools, and also, this is the important part, marketing those tools to enterprises out there that are thinking about making that transition, you spread the word and you give them, as the company called it, the easy button to be able to unlock that growth. So why do I think right now is a great time to be buying a growth stock like Confluent? Number one, it's a very high quality business. I think it's a business that is absolutely worth owning if you can buy it for at least a somewhat reasonable price. Because the bottom line is it's all about performance of the business. They have to execute, they have to continue to deliver growth for whatever price you pay to pay off. This is not a value stock situation, but there are some valuation things that I think are really important. I'm going to share it up on the screen. Something from this past earnings report that I think is telling about where things are going with the business. Sometimes it's easy to miss these little things that I think are really important. In this case, it's in the company's guidance. Company said it's expecting for the full year, $950 million in revenue. That's great. Here's the things that really matter. So non-GAAP earnings per share of 17 cents. Okay, that's I like that. It's adjusted earnings. So there's stuff they're pulling out, right, that still can be very material. This was the big one to me. Operating margin, non-GAAP operating margin of approximately 0%. Okay, is that perfect? No, but it's a big step towards profitability. They're expecting negative 4% operating margin in the first quarter, but by the end of the year to being adjusted operating margin neutral. What does that really mean? It means the company can basically live off of its balance sheet right now without any major concerns of running out of capital. Good things the company has a substantial amount of cash on its balance sheet right now, so it can continue to spend and invest in the business. But it's also at a point now where it's gotten to enough scale, and we're going to see that continue to accelerate over 2024, that it's not going to be living off of that cash to support operations. It's going to be operating income neutral by the end of 2024, which means probably in the second half of the year, it's going to be generating positive operating income. That means that the cash on its balance sheet, it can focus on using that for CapEx for growth. And if the environment requires it, it can pull back on spending and still be a functional, high quality business that can live just off of that balance sheet. Can't undersell how important that is for growth businesses that are spending lots of capital right now. Now, here's the last thing. The third thing, the last thing is talking about valuation, thinking about the stock price. We've talked about the balance sheet, where things are with operating income and net income. We've talked about the thing it's doing to potentially reaccelerate growth. Let's just talk about stock price and valuation. Stock's up 25% so far this year. Of course, it's fallen a lot in the past few weeks. It's down 15% or so. But if we stop looking at just the percentages and the short term and think about the long term, stock prices come down a tremendous amount. And at about $29 a share, that works out to about 11 times sales. Why am I thinking about a metric like price to sales? It's like the empty calories of valuation, because we can use it as a proxy for thinking about over the long term. This is a very high margin business. It's generating gross margins in the high 70s, could potentially get closer to 80% in gross margins. And at the scale that it's at now with its business as a software company, a services company, a lot of that margin is going to carry over to the bottom line because its fixed operating costs relatively low. So that gives it the ability to generate really strong operating income over the long term. And 11 times sales, that's cheaper than companies like Microsoft and Adobe that have very proven track records of delivering wonderful profits from their software suites. And they're at much larger scales. With Confluent, you have an opportunity to get in more on the ground floor, so to speak, of a business that's still earlier in its growth phase, in a more nascent emerging business with data streaming, at a great opportunity when the business is moving towards profitability. The risk is lower, but you can still get a great valuation.